All right, and we're live. Hey everybody, Smart Silver Stacker here. Hope you're doing well. Boy, we've got a lot of very interesting information to delve into in today's live stream. So bear with me because there's a lot to cover, but I'm going to talk about gold and silver, a bit of their history as real money, and how the whole financial system really is a derivative of gold and silver, and the value of everything else is predicated upon gold and silver. We'll get into that, some of the history, how that came about, and also how we may be nearing sort of a terminal phase of this monetary system in which we all learn that gold and silver really are the foundation of it. So I wanted to start off with this quote that we've got up on the screen here from J.P. Morgan, who said, "Gold is money, everything else is credit." And he said that back in 1912 in congressional testimony. Now, I would probably amend this statement slightly to include silver, and probably J.P. Morgan would have as well. I mean, he's not alive today, we can't ask him, but I just think that perhaps to somebody as wealthy as J.P. Morgan, silver was maybe just a little bit of an afterthought, pocket change for him, just a way to break a gold coin. But really, gold and silver are both money. They've been money for thousands of years, and the system that currently exists, our monetary system, was built on the back of gold and silver. And clearly J.P. Morgan, he's a smart guy. He understood the financial system better than most, I would imagine. One of the folks instrumental in creating the Federal Reserve, and he knew gold is money. I mean, there's a reason that the central banks around the world continue to accumulate gold. Now, today's video is brought to us by SDBullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. You want to support the channel, check out the sponsors and help support them. That's where I buy my gold and silver, so make sure you check them out. Now, let's go right back to the beginning here. I've got a Wikipedia article pulled up regarding the Coinage Act of 1792. I do see a few folks in the chat there chiming in. Hello, if you're joining the live stream, please do give it a big thumbs up, smash that like button, consider subscribing to the channel, all that good stuff. Help get this information about real money into the algorithm. I've got Rick Corrit saying, I was very young in 1912. Yeah, me too. Negative, actually. All right, so Coinage Act of 1792. This was essentially the act passed in 1792, if you couldn't tell from the name, that established the U.S. dollar and created the current financial system, and the beginning of the era of the U.S. dollar. Of course, back then, the U.S. dollar, very new currency, created in 1792, and it's very interesting that this act actually pegged the newly created United States dollar to the value of the widely used Spanish silver dollar, saying it was, quote, to have the value of a Spanish milled dollar as the same is now current. And that's an interesting fact that the Spanish real, the Spanish silver dollar, actually circulated as one of the primary forms of currency and money in the colonies and in the early United States. Kind of an interesting little piece of trivia. We'll take a look at that in just a moment. But I want to zoom down here and just kind of show you what was established by the Coinage Act of 1792. It defined a dollar as a measure of either gold or silver. So $1 was defined as 416 grains of silver. It's about 27 grams. And then $10, the eagle coin, was 270 grains or 17.5 grams of standard gold. So basically pegged gold and silver to one another and also to the dollar. Excuse me, let me have a little tea here. There we go. And I want to take a look at this Spanish dollar that was pegged to the U.S. dollar by that Coinage Act of 1792. Oh, before we do that, let's just take a look real quick and see. Actually, it was kind of like a three-part monetary system because copper was part of it as well. That was created by a separate act on May 8th, 1792, an act to provide for a copper coinage signed into law by George Washington. So that was a different act from the Coinage Act of 1792, but they did have some copper coinage as well. And then it's very interesting to me, this is the Spanish dollar, also known as a piece of eight. You might hear it referred to as a Spanish real. This was one of the main forms of circulating currency in the colonies. It was actually sort of the de facto international currency back in the 18th century. And, this circulated, it was official currency in the U.S. up until 1857. It remained legal tender in the United States until the Coinage Act of 1857. And that was because the U.S. was just kind of getting started. We didn't have a big minting operation set up yet. And so they needed something to help kind of be like a stopgap measure for the currency. And so this is what did the job. But, this just goes to show you that it's not, whatever currency you print or mint on the gold or the silver. It's the gold and silver itself that make it money. It doesn't matter whether it says Spanish dollar or US dollar or real or, franc or lira or whatever made up fiat currency type name you want to assign to it. It's the metal that the coin is minted on that is actually the money. It's not just what gives it value, but it is the money. Here I've got a little video queued up for those of you who just want to see some bullion. I know I'm doing like a screen share today, so sometimes you just want to see some action when you watch these videos. I get it. You get a little bit of like the TikTok brain thing, need to just see some bullion. So there's some real money for you, some gold and silver coins. And again, it doesn't matter if it's a Scottsdale Mint bar, an old piece dollar, a half dollar, or a Valcambi 1 kilo bar. It's all money. This is Exters pyramid. This is something created by John Exter back in the 1930s, I believe. And it kind of is a outline of how the monetary system is structured. And he put the most stable, reliable asset at the bottom, gold. And then going up, you can see you got paper money, government bonds and treasury bills, corporate and muni bonds, basically all these other monetary assets as you go up here, non-monetary commodities, private business, real estate. And then at the very top, this is a revised version because when John Exter first created this pyramid, at the very top he had third world bonds and debt, but now derivatives have taken that place along with the unfunded government liabilities. And certainly those things should be at the top, the most unreliable things. The unfunded government liabilities, I forget the exact number right now. I think it's about $191 trillion here in the U.S., the sum of which can only ever be funded or paid for with devalued currency. I mean, there is not that much wealth in the economy to tax. So this is an important thing, but this basically highlights how gold is the foundational unit that everything else derives value from. All this stuff is derivatives. All this stuff is basically made up, whether it be paper money, T-bills, government bonds, bonds that are backed by the full faith of the U.S. government, full faith in credit. We're going to talk a little bit about the bond crisis that is looming here in just a moment. But I want to look first at this. This is, excuse me, this is a revised version of Exter's pyramid, which just shows gold and silver. Now, I think these numbers are a little bit dated. I believe it's referring to the above ground silver and gold. But I've got some updated numbers for you that we'll get into just a minute. But, the thing to take away from this is that if gold is the base of the pyramid, silver is like a tiny, tiny little tip of the pyramid. I mean, the silver market is so small compared to gold that really you have this tiny little bit of silver at the very tip of Exter's pyramid. And that is an important thing to understand. It has a lot to do with why I primarily stack silver and not gold. I got some gold, I like gold, but I like silver even more because I think it is the world's most undervalued asset. And the fact that we can buy it for the price we can today, it's a huge opportunity. It's not financial advice. I'm not telling you what to do, but I view it as such. And, I've been putting my money where my mouth is. I've been stacking silver for going on, how long now? 13 years. So we've got a question here in the chat. Would CBDCs fall under derivatives? That's a good question. I don't know exactly where CBDCs would fall. I imagine they would fall somewhere between paper money and government bonds and treasury bills. Maybe they would be derivatives, but no, I think they would be more like a form of money that would fall in here if I had to place them. So let's see. What do we got now? Oh yeah, this is the World Silver Survey. This is provided by the Silver Institute, and this is something that I would highly recommend any stackers check out. It's chock full of interesting information, but there's a few things I want to draw your attention to here. And the first one is just the supply and demand fundamentals for gold and silver. You can see that Total gold, or I'm sorry, this is just silver. Total silver supply last year in 2022, as measured by the Silver Institute, mine production 822.4 million ounces. Recycling yielded another 180.6 million ounces. Total, just over a billion ounces of total supply, and that includes recycling. And then you can see the total demand, or the total consumption, 1.242 billion ounces. So we had a huge silver deficit last year. There was almost 238 billion ounces more consumed than were produced. So, that means the above ground supply of silver is shrinking. We're forecast 2023 for the same kind of move here, a slightly smaller deficit. It's a 1.024 billion ounces production, and we're forecast to have 1.167 billion ounces of silver demand. So again, more than 100 billion ounces that we are forecast to be in deficit this year. But this is something even more interesting, I think, and this is the above ground silver stocks, because I was looking at this Exters pyramid, and I know that that's an outdated number there, the 0.024 trillion, but I wanted to just look at this to kind of get an idea of how much silver is actually out there, because it's actually a lot less than gold. Silver gets consumed all the time. Freedom for All says only 10% of those watching tap the like button. Yeah, please smash that like button if you're watching, everybody. Do appreciate it. It's probably one of the easiest things you can do to support the channel, and it means a lot. So I really appreciate everybody who likes the videos. I try to provide interesting and valuable content for all of you. So if you can do that, I really appreciate it. All right, now back to the data here. So this is identifiable silver bullion inventories, and this is the London vaults, the CME, that's the COMEX, so here in the US, the SGE, that's the Shanghai Gold Exchange, and then the SHFE, that is the Shanghai Futures Exchange. So all these folks sitting on physical metal, and you can see that the numbers at every one of these locations have been dropping for the past 3 years. Year over year, the reduction total, negative 23%. Most of that coming out of the London vaults, but those do happen to be the biggest source. And then I'm going to read this article to you, just this brief part here, because it kind of gives you an idea of how much silver there might be, this plus some other stuff. So 2022 saw the silver market register its second consecutive deficit. Crucially, this is about the deficit. All right, here we go, down to this part. All this is important as we believe it is ushering in a new era for the silver market. Historically, due to silver's vast inventory overhang, the price of the metal was driven by its link with gold and ultimately macroeconomic factors. As a new normal of silver being in structural deficits is fast emerging, that link over time is likely to change. For the time being, we believe that there remain enough inventories. London vaulted stocks alone, after all, amount to more than 1 year's mine production. However, given our expectations that demand will continue to exceed supply for the foreseeable future, eventually much of this stockpile will be depleted. The effect of this on the price may be amplified by a possible reluctance by ETP holders to liquidate. It is important to stress here that this does not suggest the world will run out of silver. After all, our above-ground stock definition does not include coins and small bars held by individual investors around the world. In the past 10 years alone, such investors accumulated more than 2.4 billion ounces of silver in such forms. Some of that could eventually be sold back at the right price. However, historically, we have seen that such holdings are far more inert than wholesale stocks, for example, metal held in silver's terminal markets. Turning back to 2022, global identified reported stocks fell by 388.8 million ounces over the course of the year. The lion's share of this decline came from London vaults, which saw outflows of over 320 million ounces. Okay, so that's a lot to take in. Let's break it down a little bit here. We have got individual investors. So over the past 10 years, individual investors have accumulated more than 2.4 billion ounces, and in the world's identifiable silver bullion inventories, you got about 1.27 billion ounces. So, that might sound like a lot, billions and billions of ounces, but keep in mind that last year we went through more than 200 million of those just to meet the silver deficit. And then I've got my calculator pulled up here. I don't think you can see it on the live stream, But I'm just going to do a little quick math for you. So if you do 1.278 billion ounces of silver plus 2.4, and I know individual investors have a bit more than that, but let's just use that as a working number here, and you'll kind of get an idea of why I'm doing this. So that's a 3.678 billion. If you multiply that, let's say by $25 spot price, I mean, that's a little higher than today's spot prices, but let's just use that. You realize that's only $91.95 billion. I mean, this is like chump change, right? That's like what the U.S. deficit is in an incredibly short period of time. I want to look at some of the deficit numbers in just a moment, but to give you an idea, I was doing this on a recent live stream. If you look at the past 30 days, the U.S. has rung up something like an additional $300 billion in the national debt. So, you know, it's like the deficit of 10 days is the total above ground global silver supply. So it gives you an idea of just how undervalued silver is at today's prices. And listen, this, you know, this small amount of silver that exists, it does mean that there probably will be silver shortages, but that doesn't mean that we're going to run out of silver, right? Shortage doesn't mean that you run out of metal. What a shortage means is that in order to get the metal that you need, the price has to go up much higher. I mean, eventually we're going to run through this 1.28 billion ounces that exist in these global warehouses. And then, you know, are stackers going to be just selling their silver for $25 an ounce to industrial users? I mean, I'm not. I don't know about you. Put a number in the chat, please. What would be the price that it would take for you to sell all of your silver to industry? You know, like they run out of silver to make iPhones or Teslas or any of the other things that they use to make silver. Remember, silver is like the second most used commodity after oil in terms of just the sheer number of applications. There's a huge industrial demand for it, and it's growing rapidly. So, you know, what would it take for you to sell your silver bar? I don't know what it would take for me. I mean, maybe $100, maybe $150, and I might start, you know, selling some silver. Twitch Radio says you also have to calculate in-ground silver. Yeah, you kind of do, but, you know, a silver mine takes a long time to get up and running. So, you know, if we start running out of silver, it takes, I think they say it can take up to 10 years to get a silver mine running. So, you know, prices would have to be a lot higher, for one thing, to get miners to begin, you know, spending the money to extract these more, you know, costly deposits of silver. And they would have to be convinced that those prices would remain high for a long time, like 10 plus years, because, you know, silver spikes up. If you're a miner, do you want to go out and say, well, I can be profitable at today's silver price, but will that silver price be so high 10 years from now? So, you know, this is a crucial thing. These supply-demand fundamentals are going to ultimately drive the price of silver very, very high, if you ask me. We've got a few people in the chat say $80, $150 an ounce, $500 an ounce, $150 firm, $100. Would anyone sell 6 to 7 ounces of gold to buy 500 ounces of silver? Yeah, I mean, these are all good points. Would anybody sell, I'd probably sell 6 to 7 ounces of gold to buy 500 ounces of silver. I mean, I think that's about what the ratio is today. And again, you know, I do stack a little gold, but I mostly stack silver. We got Junk Silver saying, I sold 100 ounces for a new washer and dryer today, but that's why we save so we can pull through in a pinch. Yeah, well, I mean, that certainly is one reason why we stack. However, you know, and I'm not criticizing you, Junk Silver, for doing that. I mean, if you have liquid assets like gold and silver, they're very liquid. It's a great way to pay for an expense when you need something. And I mean, you know, you need a washer and dryer. So I would probably do the same thing. But it's a good reason also to have some fiat currency stashed away so you don't have to sell at a time, you know, that isn't of your choosing. Okay, so we got another quote here. This one's from Warren Buffett. He said, only when the tide goes out do you discover who has been swimming naked. And the reason I pulled this up is because the people who are swimming naked right now, if you ask me, are the folks who are in anything that isn't at the bottom of this pyramid. And we're going to get into some reasons why here in just a moment. I'm kind of done with the silver and gold fundamentals. We're going to get into some current events now. And I'll talk about why I really think that we're about to find out who has been swimming naked. And it's not going to be the stackers, I can tell you that. Is the tide going out soon? Joe Potter says, yeah, I think so. I mean, Let's get right into that. Let's get into why the tide is going out. Okay, here's one. This is pretty interesting. We were just talking about 1792. Well, here's an interesting factoid. U.S. Treasuries are on track for their longest stretch of losses since 1787. Here's a Yahoo Finance headline here. Very interesting stuff. Very interesting stuff. You can see they've got this chart here. Shows this is the first time that we've had 3 consecutive years of the 10-year government bond having declining value. We're seeing a big sell-off. A big sell-off in bonds. And I think I've got the 10-year Treasury yield pulled up here. You can see we are wrapping up a bond bull market. Now you got to remember, when bonds are increasing in value, that means that the yield is dropping. So like in 1990, you buy bonds and they've got a close to an 8% yield. The next year, when the yield goes down, the bond that you have that has the higher yield is worth more, right? I think that makes sense. And then similarly, when you're seeing the yield on bonds go up, that means that existing bonds are declining in value. So for example, if in 2020 you bought a bond that yields less than 1%, and today the current issue of the bond is yielding 4.28% or 4.25%, the bond that has the lower yield on it has declined in value, because you're going to have to sell it at a huge discount to compensate for the fact that the coupon on the bond, the yield, is so much lower, right? I think that makes sense. It's kind of a weird thing, but I hope I'm explaining that well. So we are seeing the yield on the 10-year bond moving up, and this is counter to the trend that we've been seeing for like the past 40 years. The yield has been declining. Bonds have been in a bull market since the 1980s. U.S. bonds, people have been snatching them up, and now for the first time since 1787, so the first time in more than 200 years, we're seeing 3 years of declining bond yields. What's that all about? Well, let's take a look at the Federal Reserve's balance sheet. So what is the Fed balance sheet? What is it made up of? It's made up of mortgage-backed securities, but also a lot of government treasuries, right? So this has a lot to do with why the yield has been falling, at least since 2008. And you can see that in 2008, we had the great financial crisis, the GFC as they call it, when the Fed started QE, that was buying up government bonds to stimulate the economy, make borrowing real easy, allow the government to borrow all sorts of money and spend it into the economy to quote unquote stimulate things, right? And then they kind of had QE indefinitely. They tried stopping it in 2018, and then in 2019, you had the reverse repo market begin to crash. I think yields spiked up to the interbank lending rate spiked up to something like 12%. They came out and started cutting rates once again and restarting QE. And then in 2020, they had the thing out of I don't know what I can even say that won't get the video censored in the algorithm. So you know what happened in 2020. And I guess for whatever reason, the cure for a pandemic is to just create a bunch of money out of nowhere. That was what they did. They bought up, what is this? You were about $4 trillion, $4.3 trillion before that started. And then they bought up about $3 trillion worth of government debt in an incredibly short period of time. I mean, look at that spike up, and you wonder, where's the inflation coming from? What was it Jerome Powell said? Now we understand how little we understand about inflation. Well, look, it doesn't take a genius to know that if you print $3 trillion and buy up a bunch of government debt, monetize debt like a banana republic, that it's going to create inflation. I mean, this is not a mystery, right? And then, they said, oh, well, we did that, but now we're just going to have to keep doing QE forever. So they just kept buying bonds and bonds and bonds. And then, oh, whoops, inflation started. Oh, no. So they started doing the quantitative tightening, they call it. Yeah, Cough McGee over here. I'm sorry, Walt. I'm actually recovering from a second bout with the thing that was released in 2020. I think I'm still actually positive for it technically, so I'm kind of like sequestered away at my house right now. But yeah, I'm sorry about the coughing. I know it's annoying, trust me. So let's zoom in a little bit here. And you can see that they didn't get very far with that until the banking system broke in March of this year. And they started up what they called the Bank Term Funding Program, which is where they took a bunch of those low-yielding bonds that had been taken out in 2020, took them onto their balance sheet as a loan. They're actually still using this, but still they are selling off, resuming their quantitative tightening. And this is why the bond yields have been spiking up as much as they have. However, they really haven't made much progress. Look, they were at almost $9 trillion. They're still above 8, and yet we're seeing bond yields spike up. So, imagine if the Fed were to try to actually normalize their balance sheet and sell off all the QE from COVID or all of the QE from the great financial crisis. How high would bond values or bond yields have to go in order to sell all of that off? Because again, remember, as you sell off bonds and they drop in value, the yields spike up. Yeah, thanks, Walt. He says, glad you're still posting videos. Me too. I'm glad I got something I can do for my house, right? So this is a warning from the FDIC chair. Banking industry faces significant downside risk. This is from Thursday, actually, pretty recently. And yeah, no kidding that the banking system is facing significant downside risk. He said it was from inflation and high interest rates, and that could cause profitability and credit quality to weaken. Yes, that is very likely. And this is a piece that was published back in March in Fortune, but it bears revisiting. U.S. banks are sitting on $1.7 trillion in unrealized losses, research says. Now, what were all of those losses from? The other part of the headline here is great. That's not a problem until it is. Yeah, and it's about to be a very big problem. Is it going to be a problem in 2023? Is it going to be a problem next year? I don't know. But the clock is ticking here, and this is going to be a serious problem. Now, in the past, when the Fed has needed to cut interest rates down, what did they do? Well, they just did QE, right? They just bought up a bunch of government treasuries to drive down the yield. But this time, the reason they can't do that this time around is because inflation is so high. Now, I don't think that means they're not going to try it, but they can't just come out and try to come to the rescue. They've got to do everything they can to avoid returning to QE because, they're not complete fools. And, maybe they're not idiots at all. Maybe all of this is orchestrated. I don't know. I don't have a crystal ball. I can't see inside Jerome Powell's mind. But, I think there is something to that argument. But why were banks sitting on $1.7 trillion in unrealized losses? Well, it was because they had all these low-yielding treasuries that they bought up in 2020 when the yield was so low. Going back here, they bought up a bunch of treasuries here and here and here. And now that the yields are up to 4.258%, all of those bonds are worth dramatically less than they were at the time when they bought them. And that's why the Fed did that bank term funding program. They took all of these troubled bonds with these unrealized losses as collateral. And this is going to be a huge problem for this economy. And the Fed is trapped, basically. They're going to stick to QT and rate hikes. They're going to have to because inflation is about to tick up in a very big way. Hey, Yankee Stacking, thanks for the super chat, man. Love when you're on the channel. Really appreciate that. Thank you so much. All right, so Yankee knows what I'm talking about here. I'm sure he's very familiar with this, as most stackers should be. The debt bubble that we are in the midst of is ultimately potentially going to be the thing that drives the price of gold and silver much higher. And, the whole idea of when the tide goes out, you find out who is swimming naked. Well, the banks are one of the folks who is swimming naked. They've got a bunch of worthless paper. And, this is from March. Keep in mind, in March, the banks were sitting on $1.7 trillion in unrealized losses. Well, what have the Treasury yields done since March? They've moved up even more. So imagine how big those losses are now. And eventually, one of the things we've been seeing, one of the things the FDIC was warning about is that depositors, especially people with uninsured bank deposits, are pulling their money out of the banks. And why wouldn't you, right? Why wouldn't you pull an uninsured deposit? The FDIC only insures up to $250,000. So why wouldn't you pull your money out of a bank that could potentially fail? And that is what forces these banks to then ultimately liquidate some of these bonds to come up with liquidity. So this is a real problem for these banks. And I expect that the Fed probably is going to end up having to take all these treasuries onto their balance sheet, and that is going to be massively inflationary. Yankee says the return to QE is sadly in our future, no way to avoid it. Yeah, well, there is one way that they could avoid it, right? They could, cut spending. They could institute massive austerity. They could default on the national debt. That would be one way. You could do some kind of a partial default. You could, say, pay 50 cents on the dollar or 10 cents on the dollar. And I mean, that would be catastrophic. There's no doubt about it. I mean, we've gotten into our situation where there's going to be pain one way or the other. But I think a partial default, when we pay 50 cents on the dollar, 10 cents on the dollar, whatever they could afford, and slash entitlements and slash spending would be a lot better than paying off everybody in full in worthless currency, right? Because that's the alternative. It's like, I wish I had the video clip queued up, but it's like Alan Greenspan told us back in, I think it was 2005, he said, we have a system where we can guarantee benefits in any amount that you want, but we can't guarantee their purchasing power. Yeah, Yankee says cut spending, ha ha. Yeah, I know. This is like a big joke. Got a few people in the chat LOLing at the idea of cutting spending and balancing the budget. Right. Yeah, it never going to happen. So, and it's one of the downsides of living in a democracy, folks, of living in kind of, rule by the masses, because cutting entitlements and cutting spending is never politically popular. Everybody always thinks it's a great idea until it's the cut chunk of spending that goes to them, right? So many special interests. So many people, even the taxpayer, people who've paid into Social Security. And look, I get it. You've paid into Social Security. I've paid into Social Security. You want to get your money back, but the money's not there. It's already been spent. It's like, we're going to get it, though. Don't worry. We're going to get it. It's just not going to buy very much. That is very likely. And I'm not saying that if you paid into Social Security for 50 years, and you're retired, that you should have your benefits cut. But like, does Warren Buffett really need to collect a Social Security check? I mean, maybe some kind of a means-tested system. But all of this is fantasy. It's never going to happen. They're very likely just going to inflate the currency away. So what do we got here? Here, this is a headline from Fox Business. The U.S. is paying a record amount of interest on its national debt. Interest on the national debt will hit $5.4 trillion by 2053. Now, we're already at about $1 trillion here in interest on the national debt. This is a consequence of skyrocketing deficits along with rising interest rates. So, the deficits that the government is running, for one thing, is a very inflationary factor. So the Fed and the federal government are working at cross purposes, right? I mean, they know it. I think that they just kind of act like they're dumb. They play dumb. Jerome Powell very frequently says he doesn't want to comment on, fiscal policy, on government spending. Now, in 2020, he did encourage the government to run big deficits, but now that the deficits are out of control, he doesn't want to, say anything about fiscal policy. Inflation is the easy way out. It's the hidden tax, Yankee says. Yeah, inflation really is a hidden tax, because that's the thing. All of this spending has to be paid for some way, and taxation is very unpopular. So how do they pay for it? Well, they pay for it via inflation. And the real meaning of inflation has been so obfuscated. One of the things that's crazy is if you go back and you look at a 1970s dictionary, the definition of inflation has been changed. I mean, there's very few words that are just like, fundamental normal words. I know there's new stuff like what goblin mode was one of the new things added into the dictionary. But, words like inflation don't really need to be changed. And speaking of goblin mode, that's what the Fed is going to be doing with the printing presses once the tide goes out. As they say, the Jerome Powell is going to be hitting goblin mode on the printing press, because this level of interest on the national debt is not sustainable. And, one thing that they say here in this Fox article is $5.4 trillion in interest by 2053. That's I don't know where the projection is from, but these projections are almost always understating the reality of things. If you go back and you look at the Congressional Budget Office forecast from 10 years ago, so 10 years ago, they told us that the national debt in 2023 would be something like 23 trillion. And I mean, look where we are. We're at 32.9. So when they tell you that the interest on the national debt is going to hit $5.4 trillion by 2053, just like double that, $10 trillion. I mean, now, can this experiment run that far? I don't know, but I think we're going to find out. And when we do find out, again, that's going to be the tide going out, and the banks and the folks with, paper are going to be shown to be naked. Another sign that the U.S. economy, you hear a lot about how this is the greatest economy in history, the greatest economic recovery. You hear this from both parties. Whoever's in power always wants to tell you it's the best economy ever. And you know, when they're not in office, they tell us the worst economy ever. Well, you know, the people aren't in office, they're the ones who are correct. This is from the Wall Street Journal. More Americans are ending up homeless at a record rate. This is from just a couple weeks ago, August 14th, 2023. And this is really a sad commentary on what is happening in this country. You know, we've got credit card debt at record highs, record high interest rates on credit card debt for the first time over $1 trillion. For the first time ever, more than half of those holding a credit card balance are letting it roll over and they're paying interest on it. It's the first time ever that that's happened. We've got next month, student loans are going to have to be getting repaid. Right now, about $1.57 trillion in student debt in this country. They haven't had to make payments, folks with student debt, for a couple of years now, but next month that begins again. And that is going to put even more pressure on an already squeezed consumer. And listen, I feel really bad for anybody who winds up homeless. What was it Bill Hicks said about homelessness? You know, you're only like one bar, one girlfriend, and one group of friends away from being homeless. Well, yeah, in the U.S., that is even more so the case today. And record homelessness, that's how great this economy is. That's how great this modern monetary theory is. That's how great all of this deficit spending and the destruction of the economy is. And I mean, if you pay rent or you've tried to buy a house, you understand that, I mean, it's getting very unaffordable to purchase a house. The price of housing is ridiculous. And this is just another form of inflation, right? Rents suffer from inflation. Housing prices suffer from inflation. Yankee Stacking, he says productivity is way down. Yeah. Well, he says that's how you get out of inflation. Maybe, but remember that when productivity declines, the available supply of goods and services goes down. So yeah, it's true. If you lose your job, you're not earning money and spending as much money in the economy, but whatever you were producing is no longer going into the economy. So inflation, you know, okay, so in the Austrian sense of the word, inflation is the expansion of the money supply. But when we talk about rising prices or price inflation, you know, you can call it whatever you want. I know the nomenclature gets kind of confusing. Sometimes people like to nitpick. I'm not trying to nitpick, but so you understand what I'm saying is that price inflation or the rising cost of things has two sides to it, supply and demand. So yeah, maybe demand is declining when people lose their jobs, but just remember the supply of goods and services is also falling. So this is not really a cure for price inflation. The only cure for price inflation is to stop printing money. And I know the Fed, yeah, they're trying to do their quantitative tightening. They're buying back a little bit. But remember, they still got about $8 trillion to go before they buy back all the inflation that they created over the past 10 years. And we're already seeing massive cracks starting to show in this economy. So that's not going to happen. It's also not just the Fed who is selling bonds and driving rates higher, right? It's the foreign holders of U.S. debt. Look at this table from the U.S. Treasury. In January of 2022, China had over $1 billion worth of U.S. Treasuries. Now, $859 million. They've sold off a huge amount of debt. And why are they doing that? Well, they're de-dollarizing along with the BRICS nations. You know, they're selling off U.S. debt. They are worried about sanctions. They saw what happened to Russia. They don't want to be caught holding $859 billion worth of worthless U.S. Treasuries because we freeze their dollar-denominated assets. And so they're going to do that. Also, you know, they have some economic weakness there because the Fed has been cranking up rates. The Chinese yuan has been devaluing. Well, one way they can defend their currency is by selling U.S. treasuries and also U.S. currency. They have a huge number of Forex reserves over there. I think they have like $3 trillion worth of U.S. dollars in their Forex reserves. When they sell all those dollars, you know, what's going to happen in the U.S. when all those dollars come flooding home? And Japan even, you know, they've had interest rates much lower than the U.S. for a very long time. Their currency is starting to suffer. They've been selling off their treasury holdings as well. They had $1.29 billion worth back in January of 2022, January of 2023. And I'm sorry, this is like dated numbers. There is a chart you can find on the Treasury website, which gives you the more updated, and I guess I pulled up the old chart, but this trend continues. You know, this trend is persistent. They are still pulling up. I'm going to see if I can find that for you, actually. U.S. Treasury foreign holders, because I want to get the most recent numbers. That's an old chart that they stopped updating for whatever reason. Here we go. Here's the more up-to-date table for you. Okay, yeah, here we go. Oh, you can see China sold even more. This is from June. They're down to $835 billion or $835 million worth of U.S. Treasury. So it just goes to show the trend is still in effect. Japan kind of holding tough there, but still they're selling off theirs as well. China also, they control Hong Kong's Treasury holdings as well, which you can see have been declining in recent months. But really, when you add those up, China has about $1 billion worth of U.S. Treasuries. And when they sell those, you're going to see interest rates spike up even more. Very bad for the banks. This is that Treasury to a penny website I've been looking at lately. And this is just shocking stuff. When you look at September 7th, most recent number, 32.935 trillion. And you go back to, let's just go back a month to August 7th, 32.61 trillion. You can see they've rung up almost $300 billion worth of new debt in the past 30 days. I mean, this is not sustainable, especially as interest rates are rising. This is why the interest on the U.S. national debt is going parabolic because, again, as you sell debt into the market, the yields tend to go up. So you've got China and Japan selling their treasuries. You've got the Fed selling their treasuries. You've got the U.S. Treasury selling huge volumes of new treasury debt onto the market at the same time. No wonder the rates are going up, right? I mean, $300 billion worth of new debt in a 30-day period. Annualize that. It's like $3.5 trillion annual deficit. Not sustainable. Not sustainable even one bit. And we're going to find out, how much debt you can sell, I guess. But the only way that you can run these kind of deficits in the long term, especially in an environment like we have with rising rates and rising interest payments, eventually the Fed is going to have to monetize all this debt. They're going to have to come into the market and they're going to be the buyer of last resort. They're going to buy up even more. They'll say it won't be inflationary, or, perhaps what we'll see is they'll just talk about how great inflation is. Oh, we've got all this debt. We need inflation so we can pay off the debt in devalued currency. I mean, I would not be surprised if that becomes the narrative eventually. We know that the mainstream financial media is never going to really come clean about this stuff. Now, this is another chart I want to look at. This is the Dow to silver ratio. So, one of the things that you see in times of financial crisis is you see paper assets like stocks declining. Look what happened in 1980. This is how many ounces of silver it would take to buy a share of the Dow Jones Industrial Average. It's kind of hard to zoom in here. I think it got down to as low as 20. Today it's about 1,500. The norm, in 1920, it dipped below 100. The norm is certainly much lower than it is today. We are at a very high level of stock valuation compared to the precious metals. I don't know about you, but I like to buy assets when they're cheap, not expensive. So that's why I'm primarily stacking silver. I'm not buying, tech stocks. I'm not buying into the new bubble, the AI bubble. I'm not buying Nvidia at these incredibly high valuations. No, I'm buying silver because even in 2011, we had this ratio drop down closer to 300. So that means, if you buy at 1,500, you buy silver at 1,500, and then it drops to 300, you sell your silver and you buy stocks, you get 5 times the stocks. Not financial advice. I'm just a stacker. I'm not a financial advisor. But imagine, if you get another decline like you had in 1980 where it drops to 24.50. You buy at 1,500. You buy silver here. You sell that at, 20. And you buy stocks. Well, you're getting a lot more stocks for your money. Let's put it that way. And when the tide goes out and this whole system falls apart and all those derivative assets lose their value, there will be huge opportunities for those of us with metal, with those of us with the real money. And I can't point that out enough. Also look at the gold to silver ratio. So right now, gold to silver ratio is right around 80. But look, that is incredibly high, the high end of the chart by far. Yeah, in 2020, when we saw the big sell-off, we did see it actually go up over 100. I think that's the only time in this chart that it's over 100. But look how many times this ratio has collapsed in the past century. This is a 100-year chart. 2011, it got down to about 35. 1980, it got down to under 20. In 1968, it got down to under 20. In 1919, in 1919, there was a big recession following the First World War, and you saw paper asset prices drop, and you saw precious metals gaining in value. Back then, gold, I believe, was fixed That's why this chart looks a little wonky because, one, there's not as much data, and also you got to remember prior to 1971, gold was kind of fixed at $35 an ounce, and actually at this time I think it was about $20 an ounce back in 1920 because Roosevelt confiscated all the gold and revalued it. But the point is that the gold to silver ratio collapses when there are financial crises and when you get a big metals bull market. And this is another reason why I prefer stacking silver over gold. I mean, I like gold. Gold has a lot going for it. It's got the monetary history, although, I mean, so does silver. But in more recent history, gold has been money. Central banks buy it. As far as I know, central banks don't have official silver holdings, although I guarantee you they have some somewhere. But this is just another indication of how undervalued both gold and silver are. Because remember, this ratio, every time on this chart, it doesn't decline the ratio because gold is going down. It's because both metals typically are moving up, but silver just moves faster in a bull market. So, when the metals catch a bid, this ratio drops and your silver can buy more gold. So when metals are incredibly undervalued like they are today, I view silver as the better buy. Nothing wrong with gold. It's just that, you're going to get more performance out of silver when the tide goes out, as Warren Buffett says. One last thing I want to talk about in today's live stream, and I do thank all of you for sticking around in the live stream, because I know that this one's been kind of long, kind of just covering a lot of stuff, but is manipulation. I've got a lot of comments lately about silver manipulation, a lot of very pessimistic comments. Look, it's YouTube, I get it. The pessimistic comments are nothing new, but there has been a lot of comments lately about how silver will never go up because it's manipulated, and a manipulated asset will only rise when the bankers decide to let it. Well, look, manipulation does occur, okay? This is a story from August 22nd, just a couple weeks ago. The ex-JP Morgan gold traders were finally sentenced, so they were convicted of spoofing the market. Pretty interesting. The former head of JP Morgan Chase and Company's precious metals desk and his top trader were sentenced to prison for spoofing, fraud, and attempted market manipulation. Michael Nowak, who ran gold and silver trading at the bank, so the head of gold and silver trading, and trader Greg Smith were sentenced Tuesday in Chicago by a U.S. district judge. Nowak received a term of 1 year and 1 day, while Smith was given 2 years. So really, they threw the book at these guys, don't you think? This is the stiffest sentence yet in a recent government crackdown on questionable trading practices. And yeah, I'm sure these guys got a nice little payoff from JP Morgan. I doubt very much that their cells are going to be real uncomfortable. I mean, what do you think? Do you think, put a 1 in the chat if you think that a year or a 2-year sentence is a little bit light for massively manipulating the gold and silver markets and basically stealing money from people. Put a 1 in the chat if you think that's a light sentence. Put a 2 if you think it's fair. I would be interested to know what you think. But to me, this is a bit of a slap on the wrist. But yeah, manipulation occurs. But here's the thing. Manipulation of an asset like gold or silver, especially silver. Let's talk about silver. We're already having deficits in the silver market, as we covered earlier in this live stream, right? So one of the things that we know is today's prices are not sufficient to create adequate silver production, right? To the extent that manipulation is to the downside, and it probably is, I think it's fair to say that most of the spoofing, especially any kind of long-term price manipulation, is to the downside because they need to make their financial system look more valid, look like less of a Ponzi scheme. And one way to do that is to keep the precious metals low. But you got to remember, they use the paper markets to manipulate the physical metal, which is really weird. You've got a derivative of the physical metal, that is the paper futures market, dictating the quote-unquote spot price. You got to understand the spot price is just the price of a futures contract, right? It's not the price of real physical metal. So they use these paper markets to manipulate the price of silver down. Well, if you do that for long enough, you're going to discourage silver production to the extent that shortages begin manifesting themselves. And yeah, Enns Purdy makes a good point here. He says over 70% of mine supply for silver is mined for free in byproduct mining. Well, I wouldn't say it's mined for free. I mean, they still have to, use energy to extract it. But yes, it is a byproduct of things like copper and zinc mining. That is a fact. So for one thing here, if you see a recession, that means that there's going to be a lot less of those base metals mined, copper and zinc, et cetera, because there will be less demand for them. So the silver mining will slow down commensurately. And there is some pure silver mining. And look, there would be more pure silver mining if the prices were higher, but there's no incentive because the price is low. So the longer you keep the price down, the worse the shortages ultimately will become, especially for an industrial commodity like silver, like maybe something like Bitcoin, that doesn't actually have any consumptive use. Like nothing uses Bitcoin, nothing uses it up. There's no real application for it in the economy. And I'm not hating on Bitcoin. I'm just saying you could manipulate that pretty effectively. But the problem with something like silver, where you consume a ton of it for industry, from solar panels to electric vehicles to cell phones, all this stuff, when you manipulate the paper and you keep the physical price low, you get shortages. And then, when Elon Musk goes, well, I need silver to build my Teslas, he can't go to the COMEX and buy a paper contract because you can't make an electric vehicle with a paper contract, right? You need actual physical silver. So, they can keep the paper price of silver low as long as they want with manipulation, but that doesn't carry over to the real physical metal. And this is why I stack physical metal. I don't buy shares of the SLV, for example. Hits in the chat here says, silver going to 150 an ounce and doesn't mean gold will go to 3,500. I think 3,500 is a pretty good price target for gold. I think 150, very reasonable for silver. If you take the previous 1980 high for silver and you adjust it for inflation, it's something like $200. So silver, at least in terms of today's dollars, has already actually hit a price of around $200 in the past. There's no reason to say it won't do it again. And so, manipulation, I don't think is a good reason not to stack silver. In fact, I think it's one of the main reasons why I like stacking silver. I say, hey, thanks JP Morgan traders for keeping silver low so I can accumulate it at an artificially low price, because I know what you're doing is not sustainable, and ultimately free markets will win out. And for a commodity like silver that gets consumed in large quantities, we are going to have a day of reckoning. And, whether it be physical shortages, whether it be a financial collapse in the U.S. where all of the derivative products are shown to be completely worthless and we get a return to gold and silver as money, and we get a default based on that. I don't have a crystal ball, as you say in the chat there about crystal balls. Yeah, I don't have a crystal ball, but I think it's pretty clear that we're on the verge of some serious problems. That's why the FDIC chair is warning about the banking system in the U.S. It's why we've got interest rates and inflation soaring at the same time. The fact that, the world is de-dollarizing and the BRICS nations are joining together to control the energy markets. I mean, all of this is coinciding in kind of a perfect storm. And when the storm breaks, you're going to want to have real money. You're going to want to have gold and silver. So that's it for today's live stream, folks. I do really appreciate all of you who tuned in. Let's look at a little silver here before we wrap things up. Yeah, just replay this clip for you. But this is the kind of money you want to have when things fall apart. You don't want to be holding toilet paper with presidents and numbers printed on it. You don't want to have derivatives. You don't want to have digital currency in a bank. You want to have real money, gold and silver, and that is why we should be stacking. And even if they're manipulating the assets, we should just be thanking the manipulators, because ultimately real price discovery will occur. And if you're able to buy at an artificially low price, it's a huge opportunity. Not financial advice, just telling you what I'm doing. But that's it for today. Stay safe and happy stacking, everybody. Thanks for watching. I'll catch you next time. Smart Silver Stacker out.